Hi, everybody. I'm Rita McGrath. My guest this week is Robert Siegel, who is the author of this very interesting book called The Brains and Brawn Company. And his thesis is that a lot of the fuss we've been making about digital is not terrible, but kind of misplaced, that we also need to be thinking about some other things. So Rob is on the faculty at Stanford, the Graduate School of Business there. So we share a lot of academic inside baseball. He's also been a venture capitalist and over the many years has had operating roles with a lot of brand name companies. So Rob, I'm just thrilled to meet you. Like, we haven't really met before. We've sort of interacted, but not really met. So this is really fun to be able to do.
Thanks, Rita. It's great to be here and wonderful to actually be able to interact with you in person real time.
Yeah, in whatever format this is. So we were before we went live, we were kind of moaning about the fact that parts of our house have been converted into video studios.
Right. And no pictures of my grandparents behind me anymore. Now it's all Stanford all the time.
Right. Well, books, all that. So for people that don't know you, why don't you tell us a little bit about just your journey, how you got to where you are now, and some of the things that you're passionate about?
So it was completely random and I just got lucky over time. That's kind of the truth when you boil it all down. At this moment in time, I'm a member of the GSB faculty where I teach 6 courses on innovation, product management, financial management for entrepreneurs, and several other courses on business and government. I'm also a venture capitalist. Prior to these roles, I had a handful of operating roles. I worked at large companies like Intel and GE, where I ran a division. I also was a many-time entrepreneur, started a company that made the world's first digital picture frames, and that company got bought by Kodak. Was an executive in a company spun out of the engineering school here at Stanford that got bought by Sony. And a long time ago wrote software for a company we took public in the early 90s. Did my undergraduate work at the University of California, Berkeley, and my graduate work at Stanford. Have lived in California my whole life, though I'm usually on an airplane when I'm working, if I'm not in front of the classroom. And my path and journey here really was kind of random, a series of things over time where opportunities presented themselves, where I bounced around from large company to small company and was lucky enough to be at Stanford for the last 15 years.
That's fantastic. And Stanford is interesting in that it does bring in, people like yourself that don't have traditional academic backgrounds, and I think that's one of its strengths. So that's great. So you run this course. And you were telling me how the thesis of the course actually changed over time.
Yeah, about 7 years ago, I was talking with Aaron Levy, the CEO of Box, and I had written a case on Box that I taught in one of my courses. And we got into a deep discussion about, how the world was changing and how we were seeing digital companies, many of them based here in the Valley, go after traditional businesses. And so we got into a discussion of Christensen's disruption theory of disruption coming up from underneath. But really what we were seeing in companies that blend digital and physical, now all of a sudden there was this idea that you were going to get, competition and new ways of doing business based upon how you develop products and how you organize your companies. And we were just bouncing around, how are incumbents responding and what are the disruptors doing that makes it unique? And so this notion of blending digital and physical when every product is connected, we thought was kind of the next wave of disruption, because it creates all sorts of dynamics between producers of products, ongoing communication with customers, the ability to serve customers better. And the old way of doing things that had made companies successful in the past may not be the basis of competitive advantage going forward. So we came up with this idea for the course. We called it the Industrialist Dilemma. We pulled in a gentleman named Max Vessel, who's now the Chief Learning Officer at SAP. And we thought, okay, it'll be great. We'll bring in all these disruptors. We'll show them as heroes. And then we'll bring in some incumbents. And most of them will look like dinosaurs and a few will look okay. And oh my God, Rita, we could not have been more wrong. Over 7 years of studying, what we found is that the incumbents had certain competencies and capabilities that the digital upstarts didn't have. And so some of them were actually really doing a good job of learning from the digital upstarts. Conversely, we found that some of the disruptors, they had some blind spots of understanding the importance of things like logistics and manufacturing and operating at scale. But some of them really did get it and were learning about customer intimacy in ways that kind of the established companies that maybe have been around for 50, 75, or 100 years, how they really got. And so over the last 7+ years, we got to really understand and learn kind of what were the attributes of winning companies. And then in parallel, I started a course with my old boss from GE, Jeff Immelt, looking at systems leadership. And the idea behind systems leadership is that the leaders today need to have a different set of skills and competencies that they did in the past. When everything's connected, leaders really need to understand, like, what happens when functions inside of an organization interact, and what are those dynamics? What happens when all of your products are connected, how you have to interact with those in your ecosystem? And leaders really need to be able to see the flow of what's happening in the system, because that's how things are, working increasingly so on an ongoing basis, where everything in the world is connected.
Mm-hmm. Yeah, one of my guests recently, Jay Sri Seth of 3M, says, in the popular imagination, we talk a lot about sort of the organs of innovation, so the functions and the silos, and she says we forget about the circulatory system, which I thought was a great analogy.
My colleague Robert Bergelman, one of my most treasured mentors here at Stanford, often talks about the importance and relationship. You have an innovation group and kind of an operating group inside of an organization, and we kind of keep them separate. And actually, it's the kind of the permeable membrane between those two parts of the organization that really determine how well a company is going to be able to innovate over time. Will the people in the innovation group kind of support and feed and help educate their teammates in the core business? And similarly, will the people in the core business not only appreciate the, kind of the innovation messiness that comes on the other side, but will they take in that data and learn and continue to improve their business? And, that's the notion of the enemy's outside of the building, not inside. And great companies really understand that it's not just that you're competing for budgets on the core business versus the innovation business, but how do you blend both together and then crush the competition outside?
And Bob's a mentor of mine as well, and he was absolutely instrumental in advising on my thesis, actually, which turned out to be about how established organizations develop new competences. And what I found is it's actually a measurable, fairly predictable process that you can actually look at. And he was hugely important in helping that. So it's nice to bring that memory back. So so the resulting book, which was, I think, partly inspired by the course, right? It's called The Brains and Brawn Company. Let me see if I can get this right. There we are. Brains and Brawn Company, and it's just full of interviews and anecdotes and stories that just really bring it to life. So maybe start off with just explaining what you mean by brains and brawn and the 10 factors, and how you use that to look at how a company's operating.
So I think one of the key insights we captured was that no matter what industry we were studying, whether it was mobility or financial services or healthcare, every leading organization that was doing well had this combination of digital and physical. And the popular press will give a lot of of the glory to the digital upstarts, but actually we found that the companies that really were doing well were the ones that were combining both. And then probably the easiest example for us to talk about today is Amazon, right? Amazon, and with all of their successes, we shop digitally, but yet it's their logistics and their infrastructure and their ability to get us stuff within hours or days that makes us happy customers. So we then started to look at, okay, what does that really mean to combine digital and physical? And the Brains and Brawn framework looks at 5 digital attributes, those are the brains, and 5 physical attributes, that's the brawn. The digital attributes for the brain, the left hemisphere, how well does a company use analytics? The right hemisphere, how well do they handle creativity? The amygdala, how well do they deal with empathy for employees and customers and other people in their ecosystem? The prefrontal cortex, how well do they manage risk? And finally, the inner ear, how do you balance what you own and where you partner? But on the physical side, the brawn side, the 5 attributes we saw were logistics, right? Your spine, how well do you get products and services to customers? Hands, the craft of making things. There are so many things that are changing in manufacturing, and how are companies thinking about how they produce things or partner where they produce things. Muscles, how do you operate at scale on a global basis? I mean, look at what you and I are doing right now. Is here we are in our home offices still in the pandemic, but we're able to communicate with people all over the world. Then we talk about hand-eye coordination. How well do you drive and shape your ecosystem? And then finally, stamina. How well do you survive over time? And so in the book, what we do is we look at all of these 10 attributes, and we do a deep dive on companies. Some of them are disruptors, some of them are incumbents, and people who do a particularly good job on those 10 attributes. And the hope is that the reader can look at her or his company and give your company a score on a 1 to 10 scale on each of these 10 attributes. And then you can kind of figure out broadly, how well are you blending digital and physical?
I think that's fascinating. And so early in the book, you are talking about a very venerable German car company that sort of has the burden of national productivity on its shoulders, and they don't score so well.
Yeah, Daimler is one that is really interesting. That it's a fascinating organization, and they scored very well on the brawn side. Right, they're manufacturing powerhouse, their design capabilities are awesome, even their logistics are good. But if you look at how they've dealt with things like electrification, connectivity, and all of the things that are facing the mobility industry, they really have struggled. They wanted to control the whole user experience, and they didn't really acknowledge that people want to use their smartphones for, listening to Spotify or using Waze for maps or whatever is popular in a particular part of the world. What they decided they wanted to do internally versus where they wanted to partner, they kind of kept everything to themselves. And so they really, really have struggled. And you compare that to Tesla, who had a very different kind of digital mindset first. And so while the quality of Mercedes-Benz cars are actually quite amazing and Tesla's not so much, look at the market cap of each of the companies. And more importantly, look at what customers are buying. And so the idea isn't that Daimler's a horrible company. The men and women there are brilliant. They're very smart, but they have struggled to adopt some of the new capabilities and competencies of what the market is demanding in terms of what they want in their cars and want in mobility. And so we try to highlight some of the things that Daimler has done. I would say the biggest challenge that they face is they've tried to do everything. And as one of my friends has said, if your strategy is to do everything, you don't have a strategy.
Exactly. That's great. And then you contrasted that with 23andMe.
Yeah. Anne Wojcicki is an amazing human being, just an absolute, ball of fire and energy and intelligence. And you look at what 23andMe has done with Spit and software. They have a database of over 11 million people in their DNA right now. And, it starts with this very simple, we get our ancestry, we find out if we're susceptible to certain diseases. But then with that data and information and the ongoing communication that they have with customers, they're able to target certain disease states and then can work with that information to develop drugs. And so it totally turns the whole drug development mindset on its head. And they're really, really good at the digital side. But Anne and the team were also very smart at trying to figure out if they were going to do drug development, what were the assets that they brought and where did they need to partner? And so you see in the relationship they built with GSK and Emma Walmsley, invested in 23andMe. There was a $300 million investment. They're collaborating together on drug development, taking the best practices of both companies. And what 23andMe decided to do was, look, they'll work with GSK on kind of, the manufacturing and distribution of the drugs. And so you see a company that really looked holistically at all the digital side of what they were trying to accomplish and was very smart on the physical side of what they would do and what they wouldn't do. So they actually scored higher. Now you might sit there and say, well, Rob, that's crazy, right? Look at the revenues of the two companies. And we can see now that they're both public. Now, obviously Daimler's much bigger, but if you project forward 5 to 10 years, where would I want to invest as to who I think is going to be better positioned in the market? My money's on 23andMe because I think they're being much more thoughtful and insightful about where the market is headed. Now, that doesn't mean that Daimler can't change and adjust and make improvements. But as of the time that I was writing the case on them, this was a company that I think was really, really still struggling to find its way and its spot in the future.
One of the CEOs who I admire a lot is a gentleman named Gisbert Ruhl. And you may be familiar with the Klockner story.
Yep.
Are you familiar with them? Okay. So
I did. I actually wrote a case on Klockner. So I'm with you. They're awesome.
Oh, he's just amazing and such an authentic person too. But one of his projects now that he's stepped down as CEO is he's actually wants to create this ecosystem between the established German manufacturers and the startups, kind of doing at a national scale what he did at Klockner. So I'm really interested to see how that's going to all work out.
And that was so bold. You looked at an industry of what they did at Klockner, where basically you're selling rebar for all intents and purposes, and it was done sales were done the same way it's always done. It's a low margin business, and they realized they had to create a digital marketplace to serve customers better. And it was just incredible that they were willing to lead and do that. A truly amazing leader of somebody who said we need to kind of unlearn all that we have learned and kind of run towards the disruption.
Yeah, very, very interesting. So when these large companies, and I see this all the time, when they struggle, you get this laundry list of stuff, right? Well, innovation is nobody's job. And we're afraid of failing. There's no budget for it. Oh, that's too risky. I mean, just this endless list of the normal stuff. When you see companies that are able to cut through that, is there a secret sauce that you have observed? When you've looked at so many cases now, is there something that they have in common, or is it kind of up to individual leaders and leadership teams?
Well, so I think the answer is both, but I actually want to start with the second thing you said. It starts at the top. The CEO has to be personally engaged in this and committed to it. And so this notion of the innovation team is going to be this small group of weirdos on the side that we're just going to kind of keep them around to see what happens. That doesn't work.
Skunk
Well,
work.
exactly. We'll put them in, and they'll have long hair. Like when I worked at Intel, right? I had hair and it was long, and we were kind of Andy Grove's group of weirdos. What I saw though, even 25 years ago, is that Andy and the team at Intel made sure that we had very tight relationships with the business units, and the CEO was involved in what we were doing, and the executive staff. So even though the microprocessor business was what was making us all of our money, what we were seeing at the tip of the arrow was brought in. So the first thing is the CEO has to be engaged. The second thing that we saw is that companies who have these, we used to call them wild ducks, right? The people who are kind of the crazy people inside of the company. There has to be creative structures for them, both for compensation and for organization, to actually be able to have incentives to take risks. And so that's one of the things that you really have to kind of, otherwise your great people are going to leave. Okay. And the third thing, which I think is really interesting, is you have to see where companies have the ability to say, this is a long-term commitment. It's patient capital. Like, we're not just going to become a corporate venture capital arm when our stock is going up, right? This is a part of the tools that we use for constant innovation. And so it's kind of the heartbeat and operating rhythm of the company. And so it's kind of that notion of constantly running towards the disruption. In the book, one of the things I talk about is what AB InBev, when they kind of woke up. Brito in 2014 got his butt kicked by the board of directors for not being innovative enough. And what I loved what he did was he recruited one of his rising stars, a gentleman named Pedro Earp, to become the chief disruptive growth officer. And Pedro's like, Brito, what the heck is a chief disruptive growth officer? And Brito looked at him and said, you figure it out. So Pedro's trying to figure out, should I do this? Should I not do this? And he comes up with some ideas, and he comes back later to Brito and says, how will I know if I'm going to be successful? Right. Because, like, relatively speaking, given that we're at tens of billions of dollars in revenue, anything I do the next 3 to 4 years is going to be small. And Brito looked at him and said, you'll know you're successful when your job is no longer necessary, when you've infected the whole organization such that we don't need you. And what I love about that exchange is that, even Pedro had to internalize himself. He had to take the risk with his career, and that he had to know that, like, success was defined as that he didn't have a job anymore. And if you think of people in large organizations who will often want to hold on to what they have, and they've been rewarded for doing that, for, like, building competencies and power and resources. Pedro's sign of success here was, I'm out of a job, and it was the trust that the organization would take care of him. And so I think it's kind of, some of it's the mindset, it's the engagement level, and it's that notion of, this is going to happen anyway, so we have to drive the disruption, both at a company level and at an individual level.
That's fascinating. So one of the questions I get asked all the time is, well, where does innovation belong in the organization? And so I developed this little white paper,
right.
Kind of goes from very traditional to kind of where, like, Amazon is, and where I think you're getting at, which is, so you can stick it in a business unit, probably not a good idea. You can put it in an independent division in a business unit, better, but not great. You can stick it in R&D, where, the problem with that is it's all squirrels, and it's like, oh, shiny object, You can do what IBM did and make it like an EBO and reports to the senior staff person. You can have it report directly to the CEO. But one of the most interesting things, I think, is the level beyond that, which is, it's just the way we do things around here. And I think that's kind of what you're getting at.
Yeah, I think it's a great point you make, Rita. And by the way, it's an ongoing thing. You have to look on any particular initiative. Where does it go over time? And so back to, Robert Bergelman, our joint friend and mentor, right? Robert would talk about, things will start kind of in a new group, right? We're not sure if it's strategic and it's kind of partially related to the business. And over time, if it's more operationally related to the business and it becomes very strategic, it gets sucked into the core of the business. If it's not, it might become a new business unit, or it might become a new division. And I think the mindset of the leaders is, okay, even if I don't know, I'm going to kind of keep some, experiments going, keep some things going, but I've got to constantly be checking about where this thing's going to be going. And you should be finding your innovation activities might be moving around depending upon how they're doing over time. And that gets built into the operating rhythm and the muscle memory of the organization, that people should be looking around of who's doing what and how do things need to change. Because, like, you don't want to always be kind of in the new business group, because that means you're not doing anything and not having any impact on the organization.
Yeah. I mean, I think it's one of the sort of challenges for our time. So Gina O'Connor, who's at Babson now, she actually believes you need a structural remedy. And I think Safi Bakal, the author of Loonshots, is kind of with her on that you need this. He talks about life at 32 degrees Fahrenheit, right? Where you want the tension between the liquid and the changing and the new, but you also want, the soldiers marching forward, and you need both. And I think that's just a really interesting kind of tension to navigate.
And being comfortable with that, the phase change, right? And having individuals being comfortable with the phase change. I think that's the other thing that happens in established organizations as we get older in our careers. Everyone says embrace change. Change is awesome. Rita, humans hate change. They do. Like, don't believe the BS that comes out of Silicon Valley. Silicon Valley's lying to you, because real humans around the planet, as you get older, we get comfortable in the things we do, and we got rewarded for the things that we do. And so now in a world, for example, that blends digital and physical, if you were really good at finance or operations, do you understand what's happening outside of the building that's shaping the finance and the operations of your team? And this is kind of where I think leaders really need to change now, not just at the C level, but kind of at the vice president, director, and manager level, is really trying to understand what's really going on in this world and being comfortable with that ambiguity. It's when you and I teach a class, we know what's going to happen. You and I were trained to be teachers. I don't know about you, Rita. Some days I'm better than others. Some days my jokes are funnier than others. Some days I connect better with the students than others. But if I prepare, I know what's going to happen. The leaders of these companies going through these kinds of changes right now, what they're going through is really, really hard, and we don't know what's on the other side. And so you kind of find that the leaders have to be comfortable with that ambiguity and the disruption, and also understand that it's not normal for them to be comfortable with that. And kind of that duality of the systems leader of understanding that this is really hard, making sure that they can kind of control some of their emotional impulses to whatever stimulus they're getting at a moment in time. You have to simultaneously be able to think through things, but also act quickly when your customers need it.
Well, and it's like that balcony and the dance floor, right?
You're
constantly moving between the two. So one of the previous topics of one of these talks was a thing called the CEO test, a book called the CEO test. And one of the things they talked about was that in today's environment, you really have to be comfortable in your own skin. If you're not, it will just kill you to have to adjust to this, because there's no recipe. There's no recipe. You have to start with who you are and where you are, and go from there.
Katrina Lake, she's the chairman of Stitch Fix and the former CEO. She taught us a couple of great things in our classes. And two things that she said that really stood out. The first thing is she would ask her direct reports at least once a year, if you were hiring for your position today, would you hire yourself? Right. You ask that in a room full of executives, and you kind of watch everybody in the room stops, right? Because that's kind of a scary question. And I can think of a couple of times in my career in operating roles where I realized that the world had passed me by and I hadn't kept my skills current or my mindset current. And so kind of just being comfortable of okay, yeah, I'm hitting my stride, or hey, you know what? I'm actually not doing my job well, and being able to internalize that and understand that first for yourself. I love that question that Katrina asks us, because that gives us the ability to be thinking about, what do I need to do to improve and be better at my job? The second thing that she kind of asks of her team is when they're hiring, is this person a culture fit or a culture add? And that's kind of, again, that mindset of, we want people who are going to fit in, right? I've got colleagues here at Stanford who talk about the no A blank rule, right? You don't want people who are jerks inside of your company. But on the other hand, are you really growing your organization with people who, you hope that they fit, but you also want them to be adding to the culture? And that's kind of that mindset of, what's the team that you're building, right? Because individuals don't win championships, teams win championships.
Well, and it's a fascinating question to me, because there's a lot of research, and Bob Sutton's work would be part of that suggests that high performing companies have very strong cultures, and you fit with that culture or you don't. So one of my favorite stories is one of my MBA students back in the day did a summer internship with I think it was with Disney, and she absolutely hated it. It was like everybody was smiling and Mickey Mouse and you're a guest, and everybody she did and then when she graduated, she was in the creative arts. When she graduated, she took a job with Marvel. She loved it. It was everybody's crazy, and we're making cartoon characters, and who knows what I'm going to be doing tomorrow. She loved it. She loved that kind of much more chaotic environment. So here's the dilemma, though, which is strong cultures tend to produce more homogenous points of view about the world. And so my hypothesis would be there's a period of time in which you have the culture and it kind of matches what's going on in the external environment. And then what happens is you sort of get out of fit. And that's when you need to bring in almost the genetic variations.
Absolutely. And there will be some people who will get the change internally and will go along with it. some people who will eventually get the change, and some people who will never get the change. And so when Beth Comstock was at GE, she actually told that story to my students about, like, the students asked her, where do you spend most of your time? And she said on cultural issues, as they were trying to drive digital transformation at GE, which had some wins and some challenges. And so when she said, the student asked her, what's the ratio of your employees? She said, well, a third get it right away, a third will eventually get it, and a third will never get it. And the student said, well, what do you do with the last third? And she said, well, we have to coach them out. If they're not going to be on board, they have to leave. And I turned to the students and said, let me translate. Beth just said they have to get rid of 100,000 people, right? Because GE at the time had 300,000 people. And that's a hard thing to do, right? And in a world where everything's connected, we've got technologies that are increasingly, going to continue to automate things. We're going to continue to have displacement of labor and capital. It's increased, the penetration of artificial intelligence, additive manufacturing, like jobs are going to change. One of the things that leaders need to be thinking ahead of time and anticipating ahead of time is how are they going to, help their teammates, basically be ready when certain jobs are going to go away. Like jobs are going to go away and continue to go away as we continue to evolve as a species. The question is, what are we doing, to help our, fellow workers make sure that they're ready, to skate to where the puck's going to be. And we know economically, that's actually better for a corporation, that if you can hold on to an employee and retrain them, it's actually better for the bottom line than having to let somebody go and hire somebody else. So I think it's trying to anticipate some of these changes and anticipate how the world is going to be evolving. That's going to be one of the real challenges for leaders, and the speed with which that's going to happen is going to increase because everything is connected.
Yeah, absolutely. So here's one of the hardest things, I think, as you're going through these changes, which is, in the popular imagination, we have these wonderful S curves, and you glide up an S curve and then you leap effortlessly onto the growth path of another S curve. What we forget is there's this J curve in the middle, where you're not where you were anymore. Things are changing, but now performance is actually going to decrease. And, one of the cases you talk about in the book is Adobe. And yes. I thought they took that head on in a very brave way, in a very brave way. And many companies don't have that kind of courage.
Yeah, and that's leadership, right? Leadership is the ability to say, we're going to transition like Adobe did from, enterprise sales to a SaaS model. And by the way, there's kind of the icky bit, right? Which is in the center there, where in that during the transition, all you do is you look like an idiot, like no matter what you do, because your existing sales are going down, the new sales haven't gone up yet. Stockholders are mad at you, employees are mad at you, like just like you can't do anything right. Your dog's mad at you when you come home. It's like, just no matter what, you're stupid, you're an idiot. But the thing is, like, the world's going to change anyways. Like, it's going to change anyway. So you're going to have to run towards that disruption, because either somebody's going to do it to you, or you're going to have to do it to yourself. I remember when I started my first company, that was one of the best pieces of advice I got from one of my mentors, when he looked at me and said, Rob, if there's something wrong with your business, make sure you figure it out before your board does. And I think that's kind of that mindset you have to have of how can we always be making things better? What can we do to improve? At the same time, the trains need to run on time, but you've always got to be kind of also scanning the horizon for what's coming next.
Yeah. And you have to have the patience and the time, and I think this is something that, particularly in the private equity world, and I know you've got a couple of feet planted in that world, but the timeframes are so tight and the demands are so, strong for kind of immediate results. I think it gets dysfunctional. I mean, I think there are conditions under which that model works, but there are a lot of conditions under which it doesn't. And so a great example to me of a leader who really took this seriously is Doug McMillan at Walmart, and buys basically Jet.com for $500 million, something like that. Crazy money, people thought at the time. But basically what he was doing was buying Mark Glory. And he sort of said, okay, Mark, here's everything digital at Walmart. I want you to kind of infect the company with this. And it was almost like injecting new DNA, but the board stuck with it. And one of the sort of little known stories, and my partner, Ron Boyer, and I talk about this all the time, one of the stories that doesn't get told, right, is because they shut Jet down. They took all the fancy digital brands they bought and they got rid of those brands, and everybody was like, oh, that was a flop, that was a failure. No, like behind the scenes, what it was doing was turning Walmart into this combination brains and brawn kind of company. And I think we just misunderstand those things so much when we sort of read the popular press about them.
I think two examples that reinforce that point that the listeners might find it helpful. The first is if you look at when PayPal bought Braintree, right? I think it was an $800 million acquisition, and there was zero value ascribed to Venmo in the acquisition. And yet, if you look at PayPal for about 4 years, the senior leadership team at PayPal was largely the Braintree team. that had come up, Bill Reddy and the team, and so really when they bought the organization, it wasn't just buying the competencies of Braintree, but it was the knowledge and the people. And I think that's one thing Silicon Valley often does better than large existing industrial organizations. So, I mean, the fact that Walmart got it, like you highlighted with Doug, is really kind of an outlier for a large established existing company. Whereas in the Valley, you'll see acquisitions that will be done before it's accretive to the bottom line, where you welcome people in. You're not trying to just kind of squeeze out synergies, basically cost cutting. You're basically trying to figure out how 1 + 1 can equal 3. Another example also in the retail space was Target. Right. You look when Brian Cornell came into Target, he worked to invest hard into the physical stores. But Target also, they have 250 PhDs here in Silicon Valley working on data science and data engineering that feeds not only the e-commerce side of the business, but also feeds like design of the stores, and what's the best way to make a great shopping experience, and then combining that digital and physical. And again, both of those examples are this idea of like, sometimes we're going to have to buy acquisitions, and bring people in, but sometimes we're going to have to kind of make sure that we invest in it. What I do know is that if a company sits still, they're going to die. Like humans don't live forever, plants and animals don't live forever. And there's nothing that says a company has to live forever. Like you have to earn that right every day to grow and thrive.
Well, one of the things I talk about with strategic inflection points is, you go through an inflection point and you can improve and get better, and you can suffer and get worse. You cannot anticipate this, right? You can't anticipate steady state. So I want to go back to Andy Grove, right? And Intel. And one of the things that Andy was super famous for, and I'd love your observations. He wrote this great book. Before he wrote Only the Paranoid Survive, it was about managing the organization and the importance of OKRs and what did he call it? He called it
high output management.
High output management. That's right. That's the one. And a lot of people have said that's like their Bible for management. So how do you sync up this idea that on the one hand, we've got these amorphous, weird, maybe it's a cat, maybe it's a dog, maybe it's a bird, maybe it's a bicycle kind of moments with OKRs and KPIs and all those kinds of things. And Bogdan from our listener group wants to know about that.
It's interesting. Andy, if he wasn't the greatest business leader I ever worked for, top 3. Okay, I'll let you rank. I've worked for some great people. Andy had this unique blend of like, he was operationally great. Like he knew how to make the factories run on time. You look at high output management, he talks about, and he uses simple explanations of like how a kitchen operates when you're making, a breakfast. And so he had this ability to explain very, very complex things in ways that everybody in the organization could understand. And he was always on message. At the same time, he always had, the weirdos, right? He had the people that were supposed to push us into our zone of discomfort. And he actually spent time with us, but he also held us accountable. Right. So, for example, when I was working in corporate business development at Intel, which was the predecessor of Intel Capital, the team, we had to, we were measured by whether it was investments we made as part of the corporate venture capital work, the strategic insights that we would deliver on a topic or two. And it was our job to help educate the organization and then also measure the change we were actually kind of driving into the organization. There's, you in the literature, there's this notion of the absorptive capacity of an organization, which is the ability not only to like learn what's coming out from outside your 4 walls, but then make changes because of it. And I think that's one of the things that you want to have your innovation groups to be able to do is like, okay, you have to be able to kind of, do some things that are messy. Innovation is messy and most things don't work out, but some things have to work out. Like at some point you've got to impact the organization. And if you're not impacting the organization, if you can't measure something that you're actually improving upon, then it's not worth doing. And so I think a great leader, and Andy was one of these great leaders, had that balance. Like he knew how to make sure, like, when we were building microprocessors in the 90s and 2000s, like those factories, like we knew exactly what was going to happen. We knew what our yields were. We knew exactly how to make it work. At the same time, on the innovation side, he kind of gave us space, but he also allowed us to we had to come back and say, well, here's what the impact we're actually having. Different metrics for different parts of the organization, but everybody had a metric. And I think the trick was to try to find the right metrics. You don't want to be changing them all the time, but you learn, you'll get better over time as no matter what you're doing on the innovation side or the operation side, to figure out what's the best thing, both, for the near term and also for the long term.
Absolutely. And of course, Andy used to talk about helpful Cassandras. And could you describe like, because my understanding is the not the current, but the immediately post-management team at Intel did not have that philosophy.
Well, I'm not going to talk about that. But so Andy used to tell a story about in the kind of early 90s, there was a big, debate in the technology industry of what was better, RISC or CISC. These are two different technology architectures for microprocessors. And Andy told a story where one of our senior engineers kind of came in and said, Andy, I'd like 30 minutes of your time. And this was, one of our, Intel fellows, somebody with more intelligence in his pinky than most people have in their whole bodies. And this person basically walked Andy through on a whiteboard. Let me walk you through RISC versus CISC. Let me talk to you about what we're doing inside of Intel, and let's talk through the pluses and minuses of each. And so Andy, even though he was, a master of the universe and one of the greatest business leaders at the time, was willing to be educated by somebody who was saying, hey, I'm at the tip of the spear here. Let me tell you what's going on. And Andy was not threatened by that. Andy actually had a fierce desire to get it right and not to be right. And so you want to have an organization where your helpful Cassandras, your wild ducks, whoever it is, have the ability to be respected and to be heard, and can do so in a way that will actually be effective. And so Andy was the greatest leader I ever saw at that. He used to say that he used to keep 10 of us around, that like once a quarter, he had to make sure he went and talked to the 10 crazy people to find out what was going on. Now, we didn't always get to the top of his calendar right away, right? The people who ran the factories and the customers who were paying our salaries. If he used to say, if Michael Dell called, he stopped whatever he was doing to take Michael's call. On the other hand, he made sure that he also made time for us on his schedule. And again, in high output management, one of the things that he talks about in the book is a leader's job is to manage her or his schedule. And the thing about managing your schedule, by the way, your direct reports are watching what you do. Right, your direct reports, whatever you do, that's your signal to the organization of what you think is important. Mm-hmm. And so I think, that was one of the things that Andy also understood, that if he kind of spent time with us, it was a message to everybody else. I need to listen to the crazy people because sometimes they're going to teach me new things.
That's so powerful. But I agree. It's when I see, and you can kind of feel it when you walk into a company, right? I mean, I remember there was a financial services firm, which I won't name, but I was ushered into the conference room where everybody sat. And the CEO comes in through a different door, right? And he sits himself down in his chair, which is taller than everybody else's chair. And it was just like, I was looking at him going, oh boy. And then he says, oh, and we're struggling with innovation around here. And I'm like,
Well, and the trappings that like power's fun. Like it is, power's fun. Let's not pretend that it's not. On the other hand, how does that get in the way? How does that create blind spots? One of the things that we'll talk about in my systems leadership course is, being aware of our own biases. Now, every human is biased. Now, my colleague, Brian Lowry, has done amazing research on bias, right? Bias is not a bad thing in and of itself. It's not a bad thing. That's how we evolved as a species. The issue is, are we aware of our biases? And let me give you a simple example of bias. I think bias in the popular, language of business has been talked about, issues around race and gender, et cetera. But okay, in my venture business, my partner, he was trained as a lawyer. I used to run companies. I have a bias. I look at every opportunity through an operations lens. He will look through every opportunity through a legal lens, and he was trained as that lawyer. We have biases from our education, where we came from, whatever it is that we've done in our past. And so I think being aware of those biases is a key thing. Another tool that we talk about that can be very helpful is, do you have people maybe who aren't in your organization who can tell you the truth about how you and your company is being perceived to the outside world? Because most leaders, we're not wrong in our own conference rooms. Like when we're in our own conference rooms, we're always right. The story you tell of the CEO of the chair, the person in that big chair, I bet you his team never told him he was wrong. But then the question is, do you have people outside who can say, hey, Rita, when the organization is doing this, this is how the market's looking at it. This is how the channel's looking at it. This is how your customers are looking at it. And do you have somebody who can tell you truth in a way that you're willing and open to hear what's being said?
Well, and I wonder, are boards now starting to look for those qualities more when they look at CEOs? Because my friend Thomas Chamorro per Music wrote a terrific book with a very sort of polarizing title called "Why Do So Many Incompetent Men Become Leaders?" And his argument is that when we're selecting leaders, that we confuse confidence with competence. and that the people who project a lot of confidence tend to get a lot more airtime, and they tend to get promoted, and they're more visible and this and that. Whereas a lot of the leaders, and you have a number of, particularly women that you talk about in the book, who don't do that, right? They're just kind of taking in, they're absorbing, they're being thoughtful, they're seeing how the system flows. Do you think that's something boards are starting to now wise up to? Because we've had so many spectacular flameouts of what I'll just call ego-driven leaders that that you kind of say after a while we should be getting smarter about this.
I don't know, Rita, is the honest answer. So let me be a two-handed economist here for a second. On the one hand, I think people are more aware that there are different styles and different ways to lead. And I think that the good news is where people are being more open-minded. When I talk about Julie Sweet in the book, Julie's style, to me, she exudes incredible confidence, but also it's through her competence. Like, she's one of the most amazing leaders that I've ever had the privilege of studying. And Julie's style, again, trained as a lawyer, now running Accenture, this is somebody who is like, she walks into the room and it's like, the more she talks, the more you're realizing, oh my goodness, this person is really good, and she's not the brash, bold leader. And so I think there's a world where people are realizing that there's not, one size fits all. On the other hand, I think we completely glorify Elon. We completely glorify Steve Jobs. We completely glorify, the rogue entrepreneur, who puts his or her dent in the universe, even the language we use in Silicon Valley. And so I don't know that I don't think universally we can say everything's getting better. I think some parts are getting better, but I still think there's kind of this notion of the person who's going to prove the world wrong. And that's what's celebrated. The joke I like to make again in the classroom is I tell the students, don't read TechCrunch. TechCrunch is about the same 19 people over and over again and trying to make everybody else, feel horrible about themselves because like you're struggling in your career, but look at these amazing masters of the universe. And so, I think it's getting better, but I think the media promotes what sells and people want to be able to kind of have that hero and see themselves in it. By the way, that's why we have 19 versions of Spider-Man and 18 versions of Batman and all the Marvel stuff, because people want to see those heroes and imagine that that's them. And Iron Man, let's not forget Iron Man. And Wonder Woman.
And the Hulk.
Exactly, right? That's who we all want to be when we grow up.
That's funny. So let's look forward a little bit. You've had this foot in the world of education and business operations and venture capital. It's a really interesting moment in venture capital to me, which is so much money. I mean, it's like they're just backing trucks full of cash up to the proverbial garage and sort of shoveling it out. I don't happen to think that's very sustainable. What do you think?
Well, I do have some worries and concerns, and I think it's at a couple levels. The first is what we're seeing is a massive consolidation in the venture industry. So much capital is coming in that you've got a situation where like the large venture funds, are bringing in so much capital. But that was really kicked off by SoftBank with the Vision Fund. And so now the large organizations ended up raising billions and billions and billions of dollars. And so no matter what the question is, the answer is let's throw money at it. And that's not always a good thing. And so you're seeing the venture industry, the companies will have growth divisions, mainstream venture and seed groups. In fact, it's funny, Index Ventures, one of the best venture funds, just raised a $200 million seed fund, right? So which is kind of, you laugh, that's huge for a seed fund. And so it's innovation often happens very small and happens, as experiments and trial and errors, and it's kind of a grinding creativity. And so I think the risk that we're taking is in a business that's rewarded by its outlier returns, right? Of every 10 investments a venture capitalist makes, you lose money on 6, 1 to 3 of those investments, you make a 5x, and then you need the 10th one to be Godzilla, where you need a 20x return. Well, now what's happening is to be a Godzilla, your winning companies are raising $250 million to $2 billion. And so you kind of get this kind of, no matter what the question is, the answer is you've got to be humongous, you've got to be huge. That's combined in a world of increasing data usage, even when it's connected to physical products, you need as much data as possible to feed the beast. Artificial intelligence, machine learning gets better the more data we give to the computers. So you've got this, I think it's a negative reinforcing circle where you need lots of data, which leads to lots of capital needs, which leads to a winner take all market. And so we're seeing, these gargantuan companies get built, funded by gargantuan venture funds. And so my worry is that, we're going to miss some of that grinding creativity, the ability to kind of, experiment, tinker, take your time and be patient. And so it is a big time of change in the venture industry. I don't know that any of us really know what it looks like going after it, but 4 years ago, I used to debate with some of my friends in the venture business, were the changes we've seen systemic or cyclical? And a lot of my colleagues said, Rob, it's cyclical, and you're old enough now to know that it's cyclical. We've seen boom and bust times before, and I'm all, it feels systemic. After 4 years, I'm calling systemic. Like, I'm calling that these are systemic changes and not cyclical changes. Interest rates will eventually go up. Capital will eventually flow elsewhere. The tourists will leave. But I think the landscape on the other side of this looks much more like it does now than it did 10 years ago. And I'm not sure that's a good thing for entrepreneurs. Like, I think because if you're an entrepreneur and you want to get funded by one of the great venture, companies, the answer's got to be, I can only do something if it's absolutely humongous, and I can only tell them that story. Otherwise, they won't be interested. Mm-hmm. Now, will that create an opportunity for other, firms to, other like new venture funds to come up? Maybe, but as long as the game is played where you're judged by your outsized return, you need a company to be worth $50 billion to be considered good at your job. And That's tough. That's a tough business.
Right. Well, and part of the dilemma, and Safi Bahcall has written about this in a wonderful book called Loonshots. And he talks about many of the technologies and the inventions that prove to be just world changing, were unloved, back in a closet somewhere. Mainstream people didn't pay attention to them, but they had one or two kind of passionate champions who tinkered around and eventually stumbled upon something that fundamentally shifted the constraints of what was possible. And my worry with a lot of these big funds is the things they're funding kind of look the same, right? They've got a lot of those same. We're going to, for a while there, it was, we're going to be the Uber of whatever,
Right.
And so you've got kind of almost a homogenization of the kinds of business models those kinds of funds are willing to support, and something of a neglect of other kinds of models, and there are a lot of great little businesses that are not $50 billion businesses.
So, there are 2 points, Rita, that I think you're highlighting there, which are very important, which is the first is not every business should have venture backing. There are a lot of great businesses. A question, again, I'll often ask my students is, what if I told you that you could build a business that had $25 million in revenue, dropped $6 million to the bottom line every year? And so that's 5 years from now, and it employs 45 people that you love working with. And every year you get a new iPhone, and every 3 years you get a new car that you lease through the business. Would you want to build that business? And the students say, yeah, that sounds awesome, Robin. Great. You pay yourself, call yourself $500,000 a year. Wouldn't that be awesome? Yeah. I'm like, awesome. That should never be venture backed, and that never will be venture backed. And so, by the way, most companies don't look like these outliers that we celebrate. And where a lot of the economic rents are collecting. So I think that, the first point that you're making is not everything should be venture backed is a key thing. The other one is, the time frame of a venture fund is still 10 years, which is crazy because, the time to liquidity has almost tripled for most startups, right? So it's like 10 to 12 years. One of my funds that I'm involved in, XSeed, we're a seed fund. We're usually the first money in. And if the average time to liquidity is 10 to 12 years, and I've got a 10-year fund, by definition, every investment I make is outside the life stage of my fund, right? And so that engenders all sorts of really bad behaviors on behalf of investors. And so you've got this impedance mismatch between incentives and incentive alignments with how venture is structured today. And yet the flip side of it is if you invest that early, your IRR is going to stink because it takes so long before you actually make your money, and you're not going to be on the frontier of investing of risk reward. So you shouldn't put money there. And so the model is set to break. The model, it's got to correct itself. Otherwise, I think what we're just going to end up is we're going to have more of this consolidation of larger funds, larger companies, which is then going to, lead to more government involvement and more government, monitoring, which is not necessarily bad given, that dynamic. But that's not how venture grew and evolved and changed. It's not how we, and by the way, breakthrough innovation takes a long time. To make silicon, for example, if you're going to do a new microprocessor or a new graphics design chip, it's hard. It takes a lot of money and it takes time. If you're going to do technology that impacts the climate, that takes sometimes 8 to 10 years before it's really working. And so can that be backed by venture or not? Hey, let's do another SaaS software product. It's just easier.
Right. So one of the things Steve Blank has observed is that the very nature of that investment pattern and going IPO has really changed. And he points out that many companies, it used to be you'd go IPO to fund your growth, and that you'd have that big growth spurt. And what he's saying now is, no, these companies are growing. Then they do their IPO, they pay off their backers, but then they flatline. that
Yeah.
they're not continuing that growth. And his thesis is that that's a dynamic that is undermining entrepreneurial incentives. So people don't take equity and no money and work all night long under that model because it doesn't pay off. And the second thing he observes is that it deprives the public investors of the kind of return that you used to get if you bet on an early stage IPO. And I thought that was just a really interesting observation.
The economic rents are being collected by the late stage growth investors, the hedge funds who come in. And so the public investors miss it. And then, even if you're an employee coming in, if the valuation is so ridiculously high by the time you get in, you're not going to, be able to make enough money. Even if you just got like a down payment on a house, it's almost impossible to get that. The valuations have to get so crazy. And so I think that we're seeing some of these the economics are not being spread as widely. If you look at what made Silicon Valley work, what really made it work was you had this virtuous system that got going where a company would go public and everybody would make money. Even the administrators in the company may not be a ton of money, but everybody made money. Everyone had options, and that spun off new companies and created new opportunities. And so if people don't have the ability to participate, in kind of the ongoing success of the organization, you got to wonder if somebody's going to sit there and say, do I want to take that risk with my career? Is it really worth doing? And so I think Steve's right. I think we got to come back to what are the incentives and what's the right thing for people who participate. And then with the growth of SPACs, two of the companies in the book, both 23andMe and Desktop Metal went public on SPACs. The good news is I think those are interesting companies. We're going to see over time how it plays out. But now they're public companies, right? And so that's going to create a different set of dynamics of them having to manage investor expectations, in the public markets. What if they need more growth capital? What will it be like? We don't really know how that's all going to play out because we're running those experiments right now.
Mm-hmm. Yeah, I mean, and I do think we're at a very interesting moment. We've had just record-breaking inequality, lots of haves and have-nots. There's definitely been a change in the zeitgeist towards things like public investment in infrastructure, moves towards sort of sharing the wealth more broadly. The thesis that any billionaire is a mark of a badly designed economic system. Those kinds of conversations. Do you see that actually resulting in any meaningful shift?
I actually find the conversation shallow and uninteresting.
Yeah. Okay.
Because I think that it's creating and fostering class divisions. And I think that's actually not the interesting conversation. I think the interesting conversations we should be asking are along the lines of how do we create incentives for people to innovate and try and take risks and do so in a way where, for example, in our country, how our cities are an embarrassment. Like, no matter, it doesn't matter. It doesn't matter what side of the political aisle you're on. If you go to any of our cities, you look at the number of homeless. Like, how can the richest country in the world have that situation? We've got this. I'll try to trigger as many people as I can who are listening right now with this. I'm going to argue that economic conflict in the 21st century is being shaped geopolitical conflict is being shaped by economic ideological differences, not political ideological differences. You look at what's happening in China. I'm going to call that dictatorial capitalism, right? They've taken over the tech sector. The CCP can read every WeChat message. They know where every R&B is spent. But by the way, they've been pretty effective the last 25 years. They've become a global economic and military superpower. They've taken 450 million people out of poverty. From that point of view, not a bad strategy.
Well, US, you could make the argument that Singapore, benevolent dictatorship, right? I mean, if you control all the economic strings and levers, you could get a lot done versus squabbling amongst yourselves.
All right. The difference between Singapore and China is scale. You look at the United States right now, where we're still doing some innovative things, but we've got obviously the challenges that we're seeing in society. Europe has struggled to innovate and yet a higher quality of life. So by the way, these are the three poles that are out there. So the question is, are those our only three choices, right? Are those our only three choices in how we're going to deal with society? And I think business leaders need to do, and kind of this notion of seeing the system is like, are you anticipating for your company, how you're going to be having to manage between these three different poles, if you will, because in a world that's increasingly connected, you're going to be doing business in all of these places. And how are you going to navigate through this? What rules are you going to be using as a leader to think through this? How are you going to think about things like human rights, taking care of your labor force, the future of work, right? I don't know what's going to come out of the pandemic for education, but I do know right now from my home office, I have been teaching people in the last month in Riyadh, Saudi Arabia, Sao Paulo, Brazil, Stuttgart, Germany, Kuala Lumpur, and Chicago. Right? All of a sudden, I can reach more people in more places. I know education will never be the same. That doesn't mean that the classroom is going away, but it's going to be about and, not or. And so I think leaders need to be kind of understanding and being aware of all of these socioeconomic issues that you're raising and that you're talking about, trying to think about, well, do we have financial incentives and data incentives that are leading to increased aggregation of larger and larger companies? What does that mean for our fellow citizens? And how do we structure our companies and our cities and our states and our governments in ways that make sense? And I think the biggest difference between the 20th century and the 21st century, the students that you and I are training now, Rita, they're going to have to figure out in business situations how to work with governments in ways that our generation didn't have to. They're going to have to deal with a different set of issues. And whether they're in a large organization or you're an individual who has hung up a shingle and is teaching people through the camera in their home office, you're going to be navigating through these types of issues. And I think that's a big deal. And I think it's incumbent upon us to be making sure that we're training the next set of leaders to be aware of these types of challenges so that they can make the right decisions for their employees.
Absolutely. So, geez, that time really flew. So let's just come back to the book for a minute, because I do think it's a great book. Vanna White moment here. So, let's say you're newly landed in a major leadership role. You've read Bob's book. You've seen the light. You want to do Brains and Brawn. What are some next steps? What do you guide people to do?
Well, I think the first thing is look at the framework, and you can actually rate your company on these 10 attributes, and like, how you doing? Like, give yourself a score. Are there areas to improve upon, and do you need to be shifting resources from one area to another? So that's one thing I think that any leader can do. The second thing is when you get to the chapter on systems leadership, there's things that some best practices that I've highlighted of the leaders that I had the blessing of studying about things that I thought that they did really well. The ability to kind of operate at intersections, the ability to kind of manage context and how they communicated. I call it a product manager's mindset, and understanding customers, how a product gets built, how sales are done, the self-awareness of one's own strengths and development needs. And there are 4 questions that I ask every company when I'm working with them is, what do these changes of digital and physical mean for your customers? Like, aside from your own company, like, start with your customers. Like, what's happening with them? Do you understand how they make money? And do you understand like the impact of your product and service on their income statement and balance sheet? The second is, what are you doing already that you don't want to make sure you don't lose? Like, there's something good about your company. What do you make sure you don't want to lose? The third is, what are you not doing that you need to be doing? Like, every company, like, you're supposed to be doing X and you're not. And then, okay, why are you not doing it? And generally speaking, it's people are stopping themselves. And then the last thing I ask, the systems leaders to do is, how are they going to change their behaviors? Maybe just 1 or 2 things. Like, if we're not changing and growing as individuals and as people and as leaders, right, we're not doing our jobs. And so those are, I think, you can evaluate your company and then start to think about how you're changing yourself as a systems leader. Those are the things that I would encourage people who read the book. Hopefully that's 1 or 2 things that they'll get out of it.
That's fabulous. Well, what an absolute pleasure to meet you and share some inside baseball on higher ed and the world of innovation and what's going on. And do say hi to Bob and the multiple Bobs over at Stanford if you run into them. What a pleasure. And my hope is that we continue this conversation. It'll be really, really rewarding to do that. Thank you.
Thank you. This was great, Rita. I'm so grateful for having me on. A real honor to be here.